Very good afternoon, everyone, for all the people who have joined this webinar. Today we are bringing our three new ETF NFOs. The NFOs are to be launched on Monday, and they will run till February 9th, 2023. So they are your HDFC S&P BSE 500 ETF, HDFC Nifty Midcap 150 ETF, and HDFC Nifty Smallcap 250 ETF. So it's a bouquet of three offerings that will potentially give you exposure to most of, if not all, but predominant part of India's overall market capitalization. So with me is Shikhar. Shikhar is a product specialist that we have from our team, and he has worked on this product. So before I hand over to Shikhar, who will take you through the details of this product, just wanted to say a few things, which is that we all know that India as a country is one of the great growth stories that is playing out currently in a world of huge uncertainties in terms of recession, slowdown, inflation. I think India stands out in our recently released yearbook. We brought it out in terms of why one should look at India as a potential investment destination, not only from an Indian point of view, but from a global point of view as well. So, given that India is a great story, growth story, I mean, any investor with a potentially any investor who requires equity to be there in his or her portfolio, should have a sizable equity exposure. Given that we stay in India, we live in India, why not participate in its growth? So when it comes to equity exposure, what do we do as a first rule? We have to diversify. How do we diversify? The first thing is market cap diversification. So we want to ensure that we have enough money invested in large cap, mid cap, and small cap. While this split as to how much in mid cap, how much in small cap, how much in large cap can potentially differ from investor to investor. I mean, we can typically say that predominantly put your money in large cap, have some exposure in mid cap and small cap. But most investor today, I think when it comes to passive investing, most of the money that is there is only in the Nifty and other large cap indices. There is hardly any money that is invested in the mid and small cap indices. So herein we have brought in set of three funds. BSE 500 is an all-encompassing top 500 stocks, but predominantly if you see the weightage of large cap is about over 70%, and Nifty Midcap Index is a pure mid-cap index, 150 stocks, and small cap index. Actually, this is the first small cap ETF that is to be launched in India. So this is a unique product that we have. So we'll try and answer the question as to how much to split, which one to choose. To give you a background, we believe that investors should have an allocation in all three. That's why we have launched it as one bouquet of offering. Probably you can choose, if you believe you already have a predominant exposure to large cap, you can choose one third into these offerings. Or if you think you want to limit your exposure to mid and small cap, you can have 50% into BSE 500 and 25% into mid and small. Or further, you can fine tune your split within the non-large cap portion to predominantly mid cap and less of small cap. All that can be done. So this is launched in an ETF format today. And so first of all, ETF means obviously it's a passive product. Passive means we track an index. So we have an index that three indices, and these three funds will track those respective indices. While our fundamental belief is that there is still huge scope for active fund management in a country like India, that active funds have the potential to beat benchmark for a long period of time in the future as far as India is concerned. We need to have probably some exposure to passives as well. That's why we have brought this offerings. And so how this index is constructed, how have they performed, all that we will see in the presentation. But to conclude, before I pass on the floor to Shikhar, these are very, very simple offerings. I mean, all we are saying is that participate. I mean, the tagline of this product is that the great Indian growth story, growth opportunity invites you. Capture it with our 3 new ETFs. That's a very simple idea that we are telling or communicating to the people. So, with that, I would like to take a break. We'll take up questions that you have towards the end. Right now, I'll pass on the floor to Shikhar, who can take you through the details of these offerings. Over to you, Shikhar.
Thank you, Ram. Okay, so let's start off with a summary of the main points that we'll cover, across the rest of the presentation. So the first message we want our investors to be aware of is that the winners among large cap, mid cap, and small cap, they change very frequently from year to year, and it's very difficult to know, before a year starts, which one of these segments will do the best. That's why, as Ram was saying, that it's important to have diversification across market caps, and therefore, we think it's a good idea, or we are giving this offering which will give the investor exposure to all the 3 market cap segments, because in any given year we don't know, it's difficult to know a priori which one is going to do better. Okay, second point is that, as the index names themselves suggest, the Nifty Midcap 150 and Nifty Smallcap 250 indices, they are offering you pure exposure to mid caps and small caps respectively. The S&P BSE 500 index, on the other hand, is also, it's interesting because you can think of it as an all-in-one index. Why? Because it has mainly large caps, so almost 75% is large caps, but there's also a bit of mid cap and small cap in it. So that's why we call it all in one, because it's giving you, the broadest, or some of the broadest exposure which is available amongst, all different product offerings today. Third point is, the returns, historical returns that these products or that the underlying indices have delivered. So here we see that, all the 3 indices have, over the last 3 and 5 year, on a rolling return basis, using 3-year and 5-year horizons, the indices have given an average somewhere between 11.1 to 14.4% CAGR returns. So one can easily observe that on average, these are higher than your inflation. So here you can see that, this is the power of equity. It allows you to grow your savings at a rate higher than inflation, and thus, create wealth. So, these indices in the past have been able to deliver these inflation beating returns. That's what we want to highlight. And lastly, as Ram was mentioning, that the whole sort of India growth story, one is able to participate in them through these products because they are covering large, mid, and small. So if you sort of allocate to all 3 in whichever ratio you choose, you end up with a very diversified exposure to a number of different sectors which kind of span the entire economy. Okay, so here, just very briefly, in case there are some first-time investors, or just as a quick refresher, we just kind of explain that what are these mid caps and small caps. So I'm sure most of you are aware that there are literally thousands of stocks which are listed on the exchanges. So as an investor, how do you make sense of all this, right? Like, how do you sort of classify these stocks? Put some structure around them. So the most common way to classify stocks is by their size. And that's exactly what AMFI does. So AMFI looks at how big, what's the market cap of a stock over the last 6 months, and it classifies stocks into the various categories. So the large companies are the ones, so out of all the stocks, the top 100 are classified as large. So these are the blue chip names that you will be, very, very familiar with. Then after that come the mid-cap companies. So these are companies which are in the AMFI list between 101 to 250. So in a way, they are the next 150 companies. So you can think of them as they have moderate size. They're not as large as the large caps, and neither are they as small caps. And lastly, small caps are the ones which are, neither large nor mid. So they are the 251st company onwards. So, indicatively, you get a sense of, companies which are below 16,000 or 17,000 crores in market cap are classified as small caps at the moment. So this is just again to give a high level overview of how we refer to these different size segments to better understand what's going on within all these thousands of listed stocks. Okay. Before we go to the returns, I think it's important we spend some time, talking about the indices themselves. So we'll go through, some of the large constituents, the methodology, sector distribution, so on and so forth. Again, as Ram said, these are very simple indices, very simple products. So if you look at the BSE 500, all it's doing is it's looking at the entire, BSE all cap index. So effectively, this is the universe of stocks listed on BSE and trying to choose the largest 500 amongst that large universe, to give you a broad exposure, but not having, thousands of stocks, but putting it at 500, which is anyway covering the bulk of your market cap, right? And this index is reviewed twice a year. So once in June, once in December. What this means is that the index company will then decide that, okay, maybe some new companies have come, which are also quite big, or some small companies have become large, they will be included. And any existing company, which may have, lost some of its size will be removed. So this takes place, every semi-annual, so twice a year. And it's kind of, we as the fund manager is automatically adjusting the portfolio to reflect these changes. If we come to the Nifty Midcap 150 and Nifty Smallcap 250, it's again very similar story. Again, the general idea is that they take Nifty 500 as the parent or the universe, and from there in the Midcap 150 they are choosing the stocks which are sort of between stock 101 to 250 in terms of size. So that middle segment, hence the name Midcap. And similarly, they are also, both the mid cap and small cap index are reviewed twice a year in March and September. So this again, in a way, it keeps the indices fresh. Small companies are removed and companies which are large or become large are included to replace them. Now, if we look at the top 10 constituents, so we can see, now the sort of differences, between the three indices start becoming a bit clearer. So as we had mentioned earlier, the BSE 500 is predominantly a large cap index, which is why, many of the names here are extremely, instantly recognizable blue chip names. And because these are big companies, they tend to have, reasonably large weights in the index as well. But if we look at the mid cap 150 or the small cap 250, we see that here, because there are plenty of stocks, but the stocks, you'll see here that even the largest stock is below 2%. Similarly here it's below 1.5. So here you have a lot more sort of equitable distribution of the stock weights within the index. This is because these companies generally tend to be on the smaller side, so the weights are a little bit more evenly distributed across the index. Now, I think this slide is very important to get to know again, how are the indices different from each other? Why should you have a sort of balanced allocation to all three? So if we look at the S&P BSE 500, the largest sector is financial services, followed by IT, and then your oil and gas, FMCG, auto. But now, when we look at the other two indices, then things are a little bit different. So sorry, one thing I should have mentioned is that everything in green basically indicates the top five, the largest five sectors in that particular index. So what I just mentioned, financial services to autos are the top five sectors in the BSE 500. But that's not the case with the other two. What we find is that yes, financial services are again reasonably large component of the mid and small, around 20%, but they're still much less in weight compared to the BSE 500, which is 31%. And instead of IT, oil and gas, FMCG, the sectors which tend to have more weight in these indices are actually capital goods, healthcare, chemicals, these kind of sectors. So, by the way, the green is kind of distributed between, in this table, it becomes clear that for the BSE 500, you're getting, through the large caps, mostly exposure to financial services, IT, and oil and gas. Whereas in the mid cap 150 and small cap 250, apart from financial services, you are also getting considerable exposure to, capital goods, chemicals, healthcare, so on and so forth. So hopefully, this gives you an idea of how the indices are in a way, capturing a different part of the economy, a little bit of a different focus because of their constituent companies and the weights of them. Okay, another important slide, which is discussing that. Okay, let's say that you're convinced that you should have some exposure to large, mid, small caps. Let's say, for example, you want to go and get exposure to mid caps, right? Like just to start off with. Now, as an investor, you may go to the market and say, okay, fine, these are a few mid caps I've heard of or I've done some research on, and you buy them, right? Now, there are two issues with this. One is that many people, don't have the time, the inclination, or the interest or expertise to do this kind of research. So it becomes difficult to really choose out of all these stocks which ones should you take. And when you are faced with that problem, then the index becomes a very sort of elegant solution. The ETF is a very elegant solution for you to get exposure to that whole space, but without having to do individual stock research yourself. So with sort of one click, you're able to get your basket of 150 stocks in a single security. And the other advantage of this diversified passive ETF approach is that you have Ram, could you take over?
Yeah, actually, I couldn't unmute my system. Yeah. So, so Shikhar has said, this is a great way to diversify within equities. All we are saying is that if we want to get an all-encompassing diversification within equities, these are three strategies that are there. So that's why you should invest in a combination of S&P BSE 500 mid cap and small cap. That's why this baskets we have brought in. And in terms of which slide we are in, I mean,
slide 6. Slide 6.
Sure.
So I just continue again while I'm able to.
No. I'm yeah. So just to reiterate on this slide that Shikhar is showing, I mean, if we compute the volatility in terms of the standard deviation of these three indices, they stand at about 17%, 19%, and 21%. Whereas individually, if you see all the stocks that are there and compute their standard deviation or the volatility, they are at 38%, 35%, and 42% on an average. So you can see the combination of this index as such gives you much lower volatility. That's the diversification benefit within an index as such. So each individual stock within the small cap, mid cap, and the large caps are individually volatile at a slightly higher level. At an index level, that volatility drops. So is there any stock that individually is lower than the volatility of the index? If you see, those stocks are very, very rare. 0.2% of the S&P BSE 500 is having lower volatility than the index. For mid cap, that is 1.3%. For small cap, that is nil. I mean, as an index, it has a lower volatility than each and every stock in the overall index. I think that is very, very intuitive. That's why we need to have a diversified portfolio. And within if I have to add, if we mix all these three indices, probably that overall portfolio is likely to have a lower volatility as compared to each single index's volatility. Why we see that? Because different indices perform in a different time, and that is one reason why combining this will have a much slightly smoother journey than each individual index. We can go ahead, Shikhar.
Sure.
Yeah. So how about the performance since inception? I mean, you can see that since inception, these are all equity indices. If you see from August 2006, the BSE 500, which is predominantly large cap, and the mid cap and the small cap, all three indices as equity exposure have given much higher return than many other asset classes, including inflation. That is a number one takeaway: 13%, 15%, 13%. So be it debt, be it inflation, be it gold, many other asset classes, I think equities have done better than most of them. However, if you see different time periods, different indices have done well. In 3 years, small cap has done better than the other two. In 5 years, large cap has done well. In 10 years, mid cap has done well. But if you see the overall journey over the last 16 years, I mean, while it is volatile, I mean, remaining invested in equities has paid off for the investor. So we have just brought about in terms of 1 lakh invested in 2006, how they have grown, all that we have brought in. Okay, we can move on. Okay, in terms of the year by year, I think this is a very important slide, because on a given year, we don't know which segment does well, whether it is large cap. Today, sitting now in January in 2023, whether large will do well, mid will do well, or small will do better, that we have no idea. But over a period of time, the risk return, the trade-off or the risk return profile is slightly different. But in a given year, we don't know which one will do better. That's why we need diversification. That's why we again reiterate, invest in all the three. Because for instance, if I have to go into these numbers, there was FY17 or FY19 when large caps did 9.7, mid caps did 0, and small caps did -12. Whereas if I have to say, in FY15, large caps did only 35, whereas mid and small cap did much better, with small cap at 63% returns. So different time periods, different indices do well. So if we have summarized it on the right side in terms of which were the indices that ranked number one out of these three, small cap has done highest return for 7 years out of 15, whereas large 5 and mid cap is 3. So again, different. If you want a smoother journey, it's better to diversify. And again, reiterating that, invest in all the three of them. We can move on. This is the rolling return analysis in terms of the risk and the return profile of all the three indices. If you look at the middle three columns, they are the standard deviation. When we talk of standard deviation, we know for sure that if we ask a question that which is more risky, large, mid, or small, most people will say small is more risky than mid, and mid is more riskier than large. I think that is clearly brought out here in terms of the standard deviation numbers. The small have been slightly more volatile than mid, and mid has been slightly more volatile than large. In terms of the return in recent times, mid cap has outperformed. That's what we saw in 2 slides before the journey of the performance. Yes, mid cap has done better. If you go back to that slide on rolling returns, I mean, in terms of the return, all three segments have done well, but mid caps have outperformed in the last many years. But in the next few years, how the journey will be, we still don't know. In terms of the risk return ratio, because of the higher standard deviation, small caps are looking slightly lower. But from a segment perspective, small caps are important. Probably not as important are large cap. That's why people give it a lesser weight. But since predominantly most people are expected to have slightly larger weight on passives with large cap exposure, probably you should have a 1/3, 1/3, 1/3 kind of a combination. But the numbers are in front of you. Large caps in the last 1, 3, 5, and 5 years have got a better risk-adjusted ratio, whereas in 10 years, mid-cap has slightly better than large cap. Let's go ahead, Shikhar. This is again an important slide because we have not discussed so far in terms of the valuation. The biggest concern today in front of the investor is that, are the markets very expensive? Many people say that, okay, equities are very, very expensive. Let's not invest. And people have a lot of worries at this point in time. But if you see, valuations are an important metric, but that doesn't justify being absent in this asset class. Because according to us, if you see the yearbook that we recently released, we are arguing that markets are probably reasonably valued with a slightly upward bias. Markets are definitely not cheap. We are not arguing that, but these are still okay markets to invest with a 3 and 5 year view. So when you invest in equities, at least 3 years and ideally 5 years is the investment horizon. With that point of view, these are all the PEs that we have shown here are historical numbers. One from a 1 year forward numbers. I think the numbers are much more reasonable in terms of the dividend yield, in terms of the return on equity. I think return on equity, large and mid are faring better than small, but in terms of the valuation, small is faring better than mid and large. So, however, we need to know, I mean, as investor, we don't need to be biased towards one particular segment. Diversification is the essence of investing in equities, and as long as we follow that, we are expected to have a relatively smoother journey than probably you are present in one segment only. If you can move ahead, Shikhar. Okay, so why these funds? So diversify across market caps. This point we have amply covered. Participate in the India growth story. I mean, this again we have covered because as Indians, I mean, it would be really unfortunate if you don't have adequate exposure to equities through right. I mean, there is no right split in terms of large, mid, and small, but adequate exposure to large, mid, and small is at the basic level is needed for any equity investor. One more point that I want to bring here is that HDFC AMC trusted for 20. What it means is that, I mean, recently we completed 20 years of our passive offerings. In the month of August last year, we actually completed 20 years since our launch of our first index funds way back in 2002. So we are an experienced player in this whole passives segment, and we have relatively lower tracking error in most of our products, and we have expanded our basket over the last 1-2 years in terms of our offerings on the passive side. So we've got besides the Nifty, besides the Sensex, we've got equal weight on the Nifty, we've got 100, we've got 100 equal weight, we've got smart beta ETFs, 5 of them, we've got a silver, we've got a gold ETF and a fund of fund to match both of them. We've got 2 sectoral ETFs as well, one on the IT, one on the private bank. So we have really expanded our range of offerings on the passive side. I think with these 3 launches, I mean, we are further expanding our offerings, and small caps, let me tell you, is the first ever small cap ETF in the country. So that's an added unique point about these NFOs. Can we go ahead? So presenting, I mean, we have told you about this. So simplicity, liquidity, diversification. So that is the name of the game. So simple, I mean, as far as our index solutions are considered, we want extremely simple product to track a benchmark that are kind of representative of the underlying universe. So for instance, when it comes to small cap, it is an adequate representation of the small cap universe. Same with mid cap, same with BSE 500, which is an all-encompassing solution for the overall probably not the entire market, but the predominant segment of the market, Indian market. We wish to have adequate liquidity for the investors when they come to buy and sell our ETFs on the stock market during trading hours. We try our best through market makers to try and provide that. So one short diversification of a portfolio at a very low cost. As I told you, we have an investor first approach, and we have adequate, robust investment and risk management policies and processes that govern as to what we do on the backstage when it comes to managing these products. We aim to have a tighter benchmark tracking and minimize tracking errors to the extremely possible limits that we can. Next slide, Shikhar. So that's about it in terms of these offerings. We'll take the questions that have come shortly.
Can I just mention one last thing? So, here we just have a table, talking about the NFO in a little bit of detail. So, would want to highlight three things. One is that, see, the minimum amount per application is just rupees 500. So it's very easy that even with a sum of 1500 rupees, you can get started on this journey and be able to make an application in each of the three. So this minimum ticket size has deliberately been kept very small to encourage participation from from everyone. Whoever wants to should be able to sort of take part in this NFO. Second thing is that there is no entry exit load, so that again builds up on the point of how cost efficient these products are in general. So there is no entry and exit load, so that's another plus point for the ETF. And last point is that while we're talking about the NFO now and potentially putting in a small amount as a lump sum to get started, these ETFs, many of the leading brokers, they also allow SIPs in stocks, and because it's in stocks, it's also possible in ETFs. So we just wanted to kind of familiarize our listeners with the fact that you can do SIP in ETFs as well. That is more dependent on if your broker allows it or not, but the vast majority of them do. So you can start off in the NFO to begin with, and as and when, because the markets may remain volatile due to all the sort of macro going on, you can also enable an SIP on an ongoing basis through your broker. So I thought it was important to flag these three things, specifically about the NFO and the period.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.